thanks for joining us. I'm Shauna Fleischbein with Castle Group, and I'm joined today by my colleague, Laura Bryant.
Hi. Hey, I'm Laura Bryant, the Business Development Manager with Castle Group here in Southwest Florida. And we are excited today to talk to Joe about insurance, which everybody loves to budget for the lovely increases that are only, what, 5%, Joe?
I wish.
Joe Thompson. I'd like to introduce Joe Thompson with Gulf Shore Insurance. Joe, thank you again for your time today.
Thank you, Laura and Shauna. Really appreciate being here. I know this is beyond a hot topic. It's a flaming hot topic, if you will, for condominium association boards. As we know, insurance is a massive line item for the majority of associations, if not the largest line item that they have, especially now in this market. So just a little bit about myself. I've been with Gulf Shore for a little bit over 10 years, specializing in condominium associations. I work with condos from Naples all the way up through Sarasota, Manatee County area, and work a lot with coastal condos. And it's essentially what we do. We have a niche practice specialty in our firm for this, and we handle about 800 condominium associations that we work with throughout Southwest Florida. So I look forward to getting into some of this discussion with everybody here in a minute.
Yep, we've got lots of good questions that came in prior, which if you're on that topic, I'll bring up that question that we had submitted beforehand, and then Shauna's going to monitor the questions as they come in.
Yeah.
All right, well, let's get started, Joe.
Yeah, and thank you guys for, obviously we got hit with good old Ian, when we were originally supposed to have this. So this presentation, Joe, is probably a little different than we were going to have a few weeks ago.
Yeah.
Make some alterations. So very timely subject here.
Yeah, I mean, there's no question. We were supposed to do this. I think was it before or after? I don't remember. Was it the week of? I think
it was the day of.
Yeah,
the day that
unbelievable. Yeah, so I mean, before we get into like the budget guidance piece, we'll get into that in terms of rate increases and things that we can potentially expect. We had kind of sent out budget guidance about a month prior to Ian impacting Southwest Florida. And we've had to sort of kind of retract and look at what's going on there. And we're working on a revised budget guidance. And I'll get into some of that momentarily. But just in general, I think pretty much everybody realizes the state of the property market in Florida is it's crumbling. It's in disarray. There's really no other way to describe it. And even before we were hit by Hurricane Ian, the market was in a massive negative position in terms of just the health of the marketplace and what had been going on in Florida for many years. Mostly the catalyst, being 2017, which we'll talk about in a moment. And of course, there's a lot of discussion to be had on potential legislative remedies and how the impact of Senate Bill 2D has played into this. Obviously, there was the special session that occurred this past spring that Governor DeSantis had put out there, and the legislature had a very short window of time to really look at some of these big deal items and come up with substantive change, things that were going to help reform the insurance industry from a beneficial standpoint for insurers, but also tackle all of the issues associated with 4D related to Champlain Towers South and the collapse that happened in Surfside last summer. And they've done that, I think, and there's a lot of questions on the attorney side. I'm sure people have sat through a number of panels and discussions on 4D, and there's certainly some corollaries and some issues that are happening in the insurance front that can kind of cross over and connect to 4D, which we'll talk about. But just in general, the market is just in a very difficult position. And we're going to look at it from a couple of different perspectives. One would be sort of the macro perspective, and we'll talk about domestic catastrophes and how that's played into the position that we're in right now in Florida. And when people think about these catastrophes, whether it's domestically, even internationally, it's more of an out of sight, out of mind mentality. But the insurance marketplace is a very complex marketplace that's interconnected on a global scale. So we'll talk a little bit about how those catastrophes are impacting what everybody's experiencing here in Florida and how reinsurance as well plays into that. There's also going to be somewhat of a discussion on capacity in the marketplace, and that's going to be internal capacity for certain insurance carriers that we customarily rely upon to provide different options for condominium associations, and we'll get into how capacity is dwindling in the marketplace for areas like coastal Florida. That's a very catastrophic exposed area, but not just because of the cat exposure that we have. It's more also related to a lot of the micro issues going on in the climate in Florida that are very much impacting the insurance industry as it relates to litigation and other issues, which we'll touch on. So capacity is really difficult right now. And then, of course, just talking about the catastrophic exposed property, ways that you can potentially try to mitigate, these very large increases to the best extent that you can as an association. Obviously, when these carriers want to deploy their capacity, they want to get the most bang for their buck. They want to get the greatest return for their investment because it is a business. So we'll talk a little bit about that. And then I'll gaze into my crystal ball and we'll talk about rates. And that's really what it is. I'm gazing into a crystal ball because I can't predict the future with some type of an exact science. It's a very inexact science at the moment. There's a lot of remaining variables and questions out there in terms of what the future holds and how all of these issues will play into what we're going to start to see in the first quarter of next year, the second quarter, third quarter. And frankly, I was talking to Laura and Shauna before, even in the next 2 years, because we have a 2-year window for folks to file a claim after a named storm. It used to be a 3-year window, and the legislature changed that a couple of years ago after Irma. So that's going to have a big impact on what we slowly see this, what we call loss creep in the industry, where folks, maybe they're later on, maybe they discover something that wasn't, readily observable that perhaps happened from the storm, or maybe on the more negative outlook, we have that unscrupulous group of actors, of, contractors and other AOB related players that are trying to, encourage people to file claims that perhaps don't really need to. And of course, that's going to have an impact on the market as it did with Irma. So we'll get into some of that as well. And then, of course, this is a really telling picture. This is something that we all probably remember very well. This is 2017, Irma, massive storm that just had tremendous impact in the state. Heck, even in the southeast part of the United States, it was such a large event. And I want to say to some extent, 2017 was kind of the catalyst for a lot of what we're going through, because we saw a lot of the issues in sort of the microclimate business environment in Florida really come to fruition as a result of Irma's impact. And we'll talk about, some of that in a moment after we talk about the macro aspects of it. And we're going to see the same things with Ian, maybe not as to such a great scale, because obviously with Ian, it was a double sort of kind of edged sword in terms of the perils. It was very much flood and storm surge related, Fort Myers south. And then, of course, Fort Myers north, it was wind. So we have two different kind of concurrent causation issues going on with peril. So the claims are going to be very much oriented not just on the property and the wind, but we're going to have a tremendous, and should say we do have a tremendous amount of flood claims already going on. And that's going to be a new experience for a lot of people, because obviously on the West Coast, the last time something like this occurred where there was a massive storm surge was in 1960, right? So I don't think there's anybody on this call, maybe there is, that remembers that, but if they do, they were probably 10, 11 years old at the time. Hurricane Donna, that was about, I think, an 11-foot storm surge in Naples, Southwest Florida area. But of course, at that point in time, historically, what was here? I mean, really not that much relative to the high rises and like a backdrop like you see behind Shauna there. I mean, it's a pretty extensive, backdrop. I think that's the East Coast, but either way, that's what's developed in that course of time, that type of a snapshot. And now that's what we're dealing with on an exposure basis in terms of, these claims that are occurring and the billions and billions and billions in insurable losses that are going to be happening in real time. So Ian very much has had a massive impact, and I should probably update the slide in the future to Ian now that just occurred. But that's just another example of something that was not very long ago, only 5 years ago.
Yeah.
So in terms of catastrophes, when we look at the macro aspects of what's occurring in the marketplace, we talk about, hurricanes. Everybody thinks of hurricanes that lives in Florida and the Southeast. And there's been a number of those since 2017 that have occurred. And, when you go back, well before then, back to 2004, 2005 was really the last batch of really bad named storms that we had. We had the Charlie, Ivan, Francis, Jean year. If anybody remembers 04, I do, because it was 4 storms hit Florida in one season. It was just this unprecedented situation that was very shocking for everybody, I think, really. And then, of course, in 05, we had Hurricane Wilma, which was a big impact as well. And then we had a 12-year gap of nothing, right? So during that time, we talk about hard markets, soft markets. We started to experience a soft market in about 2012. So we had that time where the rates were, double-digit decreases. I know this all sounds like a fantasy, but it happened. For those of you that were involved with community associations at the time, whether you were on the board or manager or what have you, we were seeing double-digit decreases. We were having carriers, fight amongst themselves to try to write business and with different exposures. I mean, catastrophic exposed properties on barrier islands, coastal properties, wood frame properties. I mean, they would do anything because it was just this sort of amnesia that, hey, storms don't hit Florida anymore. We're in good shape here. But 2017, created this just massive influx of named storms that occurred really all at once. And then a number of other things happened as well. Like, for example, the wildfires that people, tend to sort of just push to the side, but that's a huge issue for folks that live out west. Okay, so if you know anybody that's in California or Colorado, it's a big deal. This is something that wildfires are their hurricanes, if you will, and obviously earthquakes. But that's a big problem. And, a lot of the companies, and I shouldn't say a lot, all of the companies that underwrite those types of risks that are out west that are impacting those people are the same carriers that underwrite the risks here in Florida that are covering all of these associations in some capacity or form. So when they're being impacted by other perils that don't impact the Southeast necessarily, there's still a material impact to their business model in terms of how much capacity they can deploy, what they can do from a rate perspective. Their reinsurance might be impacted. So there's going to be a filter down effect in some shape or form, even though these things don't really impact us here in Florida. And then, of course, there was the Texas freeze that happened a couple of years ago, which was an unprecedented event, multi-billion-dollar, I think it was $14-15 billion in insured losses. I don't remember the exact number, but there were just massive losses that were associated with that. Nobody saw that coming. So when you look at sort of the culmination of all this, we have a sort of a macro map that we put out that I think is coming up on the next slide. Laura, thanks. The transition, Laura, was perfect right until then. No, okay, you're doing a good job. So this map is really showing you kind of all of the different disasters on the macro scale that we've been experiencing since 2017. You think of the named storms, the Irma that we remember, the Harvey, the Ida, the Sally, the Michael 2018 category 5. I mean, Florence, Maria. I mean, you could go on and on. It's like an alphabet soup of names that we all just kind of forget about. But all of these storms have impacted the United States in some shape or form since 2017. I mean, we had obviously Irma in Florida. 2018 was Michael, and now we're on the heels of dealing with the aftermath of Hurricane Ian, which in fact I would classify as Southwest Florida's Hurricane Andrew. There's really going to be a memorable storm that nobody's ever going to forget. It's devastating. And I can tell you that firsthand as, I have numerous clients in Naples and Fort Myers that have been impacted to the point where the buildings are just not habitable at this point in time. So it's really, really sad situation going on, and it's devastating. Really, there's no other way to put it. But all these events, when this, culminates into, in terms of insured losses, I think when you add it all up, it's like 500 billion in insured losses with these events from 2017 through, today. And the Ian numbers are still very much up in the air because we're not going to see right away, where this is going to happen immediately. The impacts that'll be felt in the market immediately are more related to underwriting changes that occur, with regard to obviously the capacity issues, reinsurers repositioning and things. That's going to be the immediate effects more so than carriers having to pay out on claims right away, because that's going to be more of a progressive sort of slower track to how that's going to impact their bottom line and their business models in the future. But we are going to start seeing some of that, come first quarter of 23 when reinsurance comes into play for a lot of these insurance companies. And I'll talk about that in a little bit, but I did like that map a lot. I thought that was a pretty telling map, a macro scale map to explain kind of what's going on on that front. But when you look at Florida on the micro standpoint of what's going on here, going on in Florida that's impacting everybody, why are we so out of control? What are these litigation issues and things people are talking about? And this is what the legislature tried to address in that, I think it was 3 days they had or something ridiculous to actually tackle these major issues. And one of the issues that is really contributing to a lot of problems for the insurance industry for carriers is out of control litigation in Florida. We're a litigation haven, even outside of property insurance litigation. Just drive down, on the West Coast on I-75 or I-95 on the East Coast. There's billboards everywhere for lawyers advertising how much they got for their client and holding a check for $500,000. So it's like we're just we just encourage this stuff as much as possible, but it's a little bit unique in Florida. The out of control litigation, the statistic that's cited often is that 76% of all property insurance lawsuits in the country are based in Florida. And I think that statistic was from 2020, and we only represent about 8% of all property insurance claims in the country. So that's a massive disparity. So how the heck is that possible? Why are we experiencing this massive amount of litigation compared to all of our other counterparts in the continental United States? And the answer really boils down to the way the law is written. It's Florida Statute 627-428, which has been on the books for a long time. It was actually put on historically after Hurricane Andrew, because Hurricane Andrew was so unprecedented at the time that there was a concern at the state level that so many carriers had just exited like overnight. They were worried about people not being able to get any of their claims paid, and just folks that were I don't want to say indigent, but people that didn't have the means to really fight insurance companies, that they were worried about what was going to happen in that type of an environment. So they said, okay, well, let's put this law on the books that if you go after your insurance carrier, you file a lawsuit, and the insurance carrier, there's some type of a judgment, to award you something in that type of a position, the carrier has to pay your attorney's fees. And that not only applies to the judgment, but also applies to if the carrier settles with you after the lawsuit's filed. So you got to think about that. That all sounded great at the time, but then we didn't have any hurricanes for many, 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 many years after that fact. And then all of this sort of came back to fruition after Irma, with folks just taking advantage of this. And part of the attorney fee structure that 627-428, which is referred to as the one-way attorney fee statute, really the colloquial way to describe that, is that the attorneys were compensated at a fee multiplier level, which is an unusual compensation structure, which is really absorbent. The fees were just an absorbent amount of fees that were being awarded. So you got to think from an insurance carrier's perspective, you're already doing business in an environment that is massively catastrophic exposed. Now, not only that you're dealing with, now you have to look at it from the standpoint of, my God, we're going to be sued out of the gate. There's this cottage industry that's been created in Florida, where these group of unscrupulous actors, whether it's roofing companies, whether it's public adjusters, whether it's litigation attorneys, and I'm not saying all, okay, because a lot of people, I get a lot of flack from attorneys say, oh, it's always blaming us. We're not blaming you. We're just saying that there's a group of bad actors out there that is perpetuating this, and they're milking and leveraging the system, and they're getting just an absorbent amount of fees. And they did get an absorbent amount of fees after Irma for a lot of these claims that were just not warranted. They were fraudulent. And a lot of it gets to, public adjusters knocking on doors. And by the way, they're doing it right now after Ian. I have numerous clients that out of the gate, right away, adjusters reaching out to them. Oh, we can guarantee you, we'll get you above your policy limits. We'll do all sorts of special testing on the building envelope. We'll find water intrusion, et cetera. It's just already out of control. So the concern is that this is going to continue in that vein. There were some adjustments to this with Senate Bill 2D during the special session this past spring, where they did kind of almost eliminate the fee multiplier compensation for attorneys, but they didn't eliminate the one-way attorney fee statute. So that still is very much in play. There's still almost a guarantee of compensation at the end of the process for the attorneys that are involved with these lawsuits. And that's something that I personally feel needs to be eliminated completely. They should just repeal that statute, in addition to AOB as well. The assignment of benefits process needs to be completely eliminated. And I really hope the legislature, which I'll talk about at the end, there's another special session that's going to be convened sometime after the general election between then and the new year. I really hope that they address it, substantively, those two issues, because until they do, from a business standpoint, insurance carriers look at Florida, they're like, why in the heck would I want to do business there, where I have to now model for not only these catastrophic losses that are impacting Florida with all these hurricanes and things, but now I have to model somehow for the possibility of you suing me and me having to go through protracted litigation with you for years, and say we end up settling for a small amount, but then I have to also pay all of your attorney's fees on top of that. I wouldn't want to do business in that environment. And that's why a lot of the carriers have pulled out. We'll talk about that, in a minute, but this is a big reason why we're in the predicament that we are. And it's a huge problem for the state of Florida right now. And it's still not quite remediated to the point where it needs to be.
Yeah. So Joe, one of the questions that came in prior was, are there limits as to what attorneys can charge for FEMA claims?
So that's an interesting question, because the statute the way it's written, I believe the language is that it's related to an insurer. So I don't know if they would view the NFIP FEMA as an actual insurer. So that's a good question that I would probably have to defer to what an attorney would come back and answer on that for litigation. But I do know FEMA doesn't accept public adjusting, so that's not something that's ever going to work. But one thing to note about FEMA claims real quick is that the FEMA policy is a one size fits all, black and white policy for condos. There's zero difference. It's the RCBAP, the Residential Condominium Building Association policy form. What's covered and what's not covered, it couldn't be any more clear. It's black and white. So there's really zero reason to even hire a public adjuster for that type of a situation, unless you just want to give away 10% or whatever the percentage is of your ultimate claim from FEMA. There's no other reason to do it. They're not going to get you above the policy limits. They're not going to find you coverage that you're not covered for. It's a very clear, federal policy, for better or for worse, that every condo association is dealing with right now that was impacted by storm surge. So the other piece to note, the FEMA adjusters, or I should say the catastrophic adjusters that work as a independent contractor on behalf of FEMA, they get paid by how much they get the insurance. So the more coverage they get from FEMA for the insurance, they get paid more. So it's very different than dealing with a private insurance company where you're dealing with the fiduciary agent of an insurance carrier, like a property claim, where they're really trying to protect the insurer and they're trying to find ways to maybe dodge giving you coverage. And in that case, you may want to look at a public adjuster down the line if there's some basis of a dispute on your property claim. But FEMA, very different process. Those adjusters don't work for an insurance carrier. They're effectively independent contractors that travel the country. They're catastrophic adjusters, and they're going to be adjusting it based off of the one size fits all policy through FEMA.
Great, thank you.
So kind of keeping in that litigation vein real quick, because that statistic about 76% of all property insurance lawsuits, were in Florida, that was from 2020. I had kind of researched this a little bit more for 2021, and I found a couple of good articles about this. You would think that some of the litigation has maybe slowed down with some of the reforms that have been kind of come to fruition and tweaked a little bit. In 21, look at the difference in litigation. So property residential claims litigation in Florida, 107,000 in Florida. Okay. So look at California, second place, 3,900. That's huge difference. And California has like 40 million people,
right?
Or like 22 million or whatever it is. So I mean, it's just shocking. So obviously it still needs to be fixed. That's a huge issue. But just think about all those carriers that are part of that. They're all going to have to pay, whatever those fees are. And again, it's just a shocking way to do business. That that again, it's pretty obvious why a part of the market is crumbling is due to the litigation. There's no question about it. So this is an interesting thing. I'll try to rip through this pretty quick because I know that we've got a limited amount of time here. But we put this kind of bullet point 2-slide piece together to show you the carrier and market happenings over the past about a year and a half. What's been going on in terms of big impacts to the marketplace that impact condominium associations. One of the biggest things that occurred about a year and a half ago was one of our really super competitive carrier partners, Lexington, which is owned by AIG, pulled out of the marketplace, and that really sent shockwaves through the industry because they were so competitive on property, and it was what we call like a ground up program, meaning they would write all of the total insurable value on one policy. And it was part of a very competitive program called the Coastal Condo Hotel Motel Program. And it impacted a lot of insurers because after that program sort of disappeared temporarily to find other carriers to kind of fill the void that Lexington left, the next available rung of alternatives was just not as nearly as competitive as Lexington was. So that was a huge problem in the marketplace that impacted a lot of folks, a lot of condo associations. And not long thereafter, Everest, which was another great partner, they used to do up to like 100 million in insurable value on one policy, and they had it on an admitted basis. They pulled out, and the reason they pulled out was because they were dealing with so much litigation from Irma. When we got to like the 3rd year anniversary of Irma, right around that time, prior to the 3rd year anniversary, they had like 60 more claims open up. Think about that. So almost 3 years goes by. Then you're like, oh, maybe we should open an Irma claim. I feel like we've got some damage here. We've talked to a public adjuster. So they just threw the towel in. They were like, you know what, we're done. We can't deal with this anymore because we're going to have to defend all of these claims. And then if we settle for some tiny amount, we're going to have to pay everybody's legal fees. So it's like just a ridiculous, business prospect for them from that standpoint. So they pulled out of the market. But again, each one of these different events triggered sort of a ripple effect in the marketplace, a very negative ripple effect, because now in the absence of those competitive carriers, you have to go to the next rung of carriers available, and they're going to be less competitive. And that's unfortunate. Then, of course, for those of you that probably remember on the call, the American Capital got downgraded, and that was a big issue that created turmoil in the market because they were another carrier that a lot of condo associations were with. And then after the downgrade, they ultimately went insolvent. So we were scrambling to provide, different options for folks that had been with American Capital. And that was a shocking, piece too, because they were AM Best rated. They were a weak AM Best rated company. They were a regional AM Best rated, and they were also admitted. So it was a great option in hindsight. When you look back and I think about it, and some of the different renewals we had, when they came in, they were so much more competitive than everybody else. I think nobody really saw the writing on the wall, and then finally realizing it now, like, oh, wow, they were doing that on purpose to stay afloat so they could keep business on their books. But, they went out of business. So with those 3 big exits, it was a huge, huge problem for everybody. And then, of course, Weston, some of you may be familiar with, was a Citizens takeout company, wind only. They started non-renewing, this is about a year ago, non-renewing over 500 condo associations, a lot of which were coastal. Had a major impact on those properties because they were paying basically subsidized rates for years. And then not long thereafter, Weston also went insolvent. Citizens started to pick up a lot of market share, which is a scary thought, because in the absence of other, A-rated, standard market options, folks turned to Citizens, which is, as most of you are aware, it's kind of the state entity, if you will, or market of last resort. Not a place you want to be if you don't have to be. But for the first time in 10 years, their market share starts increasing considerably. And then to add, insult to injury, as we go down the bullet points here, related more so to all of the post-COVID inflation issues with supply chain and cost of labor, material, et cetera, we started getting these crazy insurance replacement cost appraisals. They were coming in for folks like second and third year appraisals that were like 30-40% increase in insurable value, which has a direct material impact on the cost of your insurance. So, all this stuff going on top of that, all of a sudden you get a new appraisal. Oh, by the way, your appraised value is 30% higher. You're like, wait a second. The last time we had a 30-year appraisal, it went up like, 8-9%. What gives? Well, now they're just pointing to all the inflationary issues and saying, oh, this is the new normal. We have to deal with the methodology that we use as appraisers, et cetera. So that has a huge impact on what you pay for property insurance as well. And we can't control that. So if we say, hey, the rate's going to go up 30-40% next year, and you say, well, wait a second, we just got a new appraisal where our appraised value is going up 40% as well. Now we have to account and capture that additional value at that new rate. And that's going to have a huge impact on your budget. So we have to think about that really closely as you're budgeting for your insurance costs. If you're getting a new appraisal as well, there's going to be a certain amount of additional premium at that new renewal rate that has to capture that new insurable value. And that's going to be part of your policy too. And that's going to be over and above the rate increase. It's going to be separate, but it's going to be a net increase when you combine the two over what you're likely budgeting for right now if you're dealing with that.
So Joe, in regarding, I know this is with appraisals, but what about the milestone inspections? Is that also a kind of a high-rise tower report card for insurance companies?
Yeah, that's a good question. So the milestone piece is important, obviously, that's all part of 4D. And what we're seeing now is that the carriers, just completely aside from the requirements of 4D with the 30-year and the 25-year, if you're within 3 miles of the coast, the carriers are asking for any buildings that are typically 40 years and older. They're already asking for engineering reports. The casualty carriers are asking for that. So in the absence of providing an engineering report, some are saying, oh, well, we're waiting to get clarity. We're hoping there's some type of a glitch, legislative remedy for all these issues with 4D, because there's so many questions with 4D on the reserves and the milestones. I mean, it's ridiculous how many questions are out there. So I wouldn't wait. If you're an older building, older association, get your structural report. And again, if you can get it to align with whatever those requirements of 4D might be, great. But the carriers are just asking, saying, okay, we just want a structural integrity report. They're not telling us any kind of a format they want. All they want to see is that the report is effectively giving you a clean bill of health as an older property. And if it doesn't, if it identifies issues, it might say, okay, hey, there's minor spalling issues or whatever. They want to make sure that those issues are addressed, repaired, remediated prior to the effective date. And if they're not done prior to the effective date of the policy, you generally will not be eligible for a lot of the more preferred casualty markets that are the ones now becoming commonplace as ones that would write a lot of these older risks. So if you don't get those, you're put into a kind of a lower rung of next, standard market carriers that will provide coverage, but they're providing it on a limited basis, meaning they're giving you, the limits in terms of the, gen aggregate 2 million, et cetera, but you'll have exclusions embedded in the policy, like ones that we've seen for some that are having major work done and they're older than 40 years. And they're like, hey, we can't get this work done fast enough. It's going to take a year. What do we do? Well, then pretty much every carrier is declined. And then the few that provide an option are saying, okay, here's our option. However, there's an interior building collapse exclusion. There's a water damage exclusion related to property damage or bodily injury. There's a balcony injury exclusion, et cetera. So they'll basically carve coverage out for any type of a event with the building's integrity being compromised because of Champlain Tower South, 100% because of that. And then, that's been an issue that I think the older properties really need to contend with on the front end proactively.
Yeah. There you go.
So speaking of that, segue again, Laura, your timing's just perfect on these slides. So the Surfside collapse tragedy, again, going into the timeline of things that we've been experiencing that have been just hugely impacting the marketplace for what we do. So when that happened, again, major ripple effects through the market that we didn't readily see at the moment when it happened because it was such a massive tragedy. Everybody was just reeling from that. But once that did occur, right away, one of the very competitive markets that we use for X-Wind, and I say X-Wind, sometimes we'll pair a wind option, one carrier doing your wind, and we'll have another carrier doing a property policy handling all perils apart from wind. So there's two property policies. Great American was one of the carriers doing that, and they were actually they were the X-Wind carrier on Champlain Tower South. So when that happened, they paid out the policy limit and then they pulled out of Florida. They said, oh, we're done with Florida for X-Wind for condos forever. We're not doing it anymore, at least in the foreseeable future. That created a ripple effect in the market because now, in the absence of that very competitive X-Wind carrier, we're dealing with different companies now that have always been there that would do that type of risk, but they're coming with a higher rate. They're coming with worse coverage. So it's just another piece that adds to the additional cost of what we're ultimately trying to put together for insureds when we're dealing with the available tools that we have access to. All of these different carrier exits create a consequence in the marketplace, and it filters down and down and down. And it creates capacity issues and limitations of carriers. A lot of these carriers that are doing these different exposures now, they've always been available to do it, but nobody's ever gone to them because they've been so cost prohibitive. But now they're like, hey, we're still here, but they're realizing they're the only options now in some cases, in the absence of going to Citizens or something. So the Champlain Tower South tragedy also impacted the casualty market, which we just talked about with, the 40 years or older associations, having issues with getting coverage without an engineering report. A lot of the markets pulled out. A lot of the admitted markets that used to write general liability no longer do for older tower. Actually, we had one in Philadelphia. They said anything 2000 or older, they're no longer going to do general liability for any tower at all. They completely said, pulled out, totally, which was very disappointing because it was a great product. Umbrella markets are tightening extremely right now, which is a huge problem because traditionally associations would have a 25 mil standard, limit for umbrella through a risk purchasing group product, which is the most common one that we would use for community associations. Well, one of the most competitive ones, coincidentally, was also the umbrella carrier for Champlain Tower South. They paid out the policy limits of their umbrella, and then they abruptly pulled out of the state as a result because one of their reinsurers, Fireman's Fund, was like, no way, we're done. So that created a ripple effect in the umbrella market as it did with the casualty market, as the property market is seeing. So all these different ripple effects impacting different lines of coverage because of these different events that have been happening in the marketplace. That's umbrella placement's been very difficult for certain insureds, and it's getting harder. And there's a few programs left, but they're not as competitive as the ones that are no longer writing these classes of business. We talked about the X-Wind market that's hardening because of Great American. And then on top of all this, not that we have enough problems to deal with, FEMA rolls out its new rating methodology, Risk Rating 2.0, which is effectively looking at a comprehensive redo of the National Flood Insurance Program from a rating standpoint. So now folks are looking at 18% increases in some cases for what they can expect on their rates for flood, because FEMA is trying to get everybody to their actuarially sound rate. And that's something that they want to do sort of very, gently and progressively. They're not a private insurance company. So they're going to say, okay, nobody's going to pay more than 18% a year until we get you to your full risk premium, which will show you on your new declaration page after you've renewed after April 1st of this year. Your new deck page will show you that top end number that you're going to pay into with FEMA. But that's kind of the new thing. They're going to get you up to that stair step, 18% a year until you start paying to that limit. And unfortunately, that's out of our control. We have no control over the National Flood Insurance Program from that standpoint. It's a federally subsidized program. Private market can't compete with anything that's federally subsidized, and that's going to be the new normal with flood. And that was the first real big change that they've done in really, I think, ever, a really long time. And then another, piece that's happened, Citizens now in August exceeded 1 million policies. And it's looking to lift potentially the cap it has on residential homes, meaning that Citizens is expanding. They want to expand their guidelines to write some of these higher end homes that right now are capped to 700,000. So residentially, they're looking for, maybe even doing a higher limit than that, which is not a good sign for the market, because what that says is that these homes residentially that are, along the coast and both sides of Florida, they can't find coverage in the standard market. So they're all looking to Citizens now. And it's a huge problem because, as we know with Citizens, we run the risk of assessments on Citizens policyholders in the event that Citizens can't handle all of the losses. And then on the whole, everybody on this call that's, has a policy in Florida, insurance policy, we're effectively the reinsurance for Citizens, because ultimately they can assess every policyholder in the state of Florida to be made whole, to pay claims for folks that are being, destroyed during these catastrophes. So that's the other kind of crazy thing about Citizens that's going on. And then, of course, in September, we had the 6th Florida domiciled property carrier was declared insolvent. So add that, more insult to injury going on in the marketplace. And what happens when these domestic carriers go insolvent? Either the risks that they were writing go to the excess and surplus lines market, which has a direct impact on condo associations, because now they're soaking up more capacity that it was already, very limited on, that was in the marketplace, or those folks are going to Citizens. And then, as we all dealt with, before, this is one of my new bullet points. So we put on there after the storm, Hurricane Ian makes landfall, which was not a fun process for anybody that dealt with that. And what are we going to see from this? Time's going to tell. I think, we'll talk about, I want to waste too much time here. I think we've got more slides to rip through, but that's going to have a big impact on everything. And then, of course, right now we're dealing with a new business moratorium on any property in the counties impacted by Hurricane Ian. So if you're renewing between now and 11/28, there's no new carriers providing you an option. The Office of Insurance Regulation, State Insurance Commissioner, sent out effectively a legal proclamation stating that incumbent carriers have to offer a renewal or they have to extend to 11/28. But right now, no other carriers are providing any option to anybody between that time frame. So that's how much the market is sensitive right now because of Hurricane Ian.
Hey, Joe, while we're on this slide, there was a question that asked, does every association need an umbrella policy?
Absolutely. Yeah, so umbrella policy, so important. I mean, it's going to be sitting over as excess, your general liability, your directors and officers, your workers' comp, your hired and non-owned auto liability. So if you ever, go through any of those primary limits through some type of a catastrophic claim, this is not property related. I mean, anything like a casualty claim, bodily injury, et cetera, you want to have a robust limit for an umbrella. And again, the umbrella market is under significant strain right now because of those issues that I talked about before, but it's still worth absolutely exploring. If you can't get a true risk purchasing group product, we're doing now excess liability products for folks as an alternative. It is much more expensive, unfortunately. It's not that, cheap umbrella. For years, people are like, hey, we've paid $3,500 for 10 years for 25 million. Now you're bringing us 5 million for 25,000. And we've had situations like that where if it's an older association, if there's short-term rentals, if it's a building that's not fully sprinkled, those have posed a lot of problems for a lot of the risk purchasing groups that are left. So despite all of those difficulties, yeah, you still really need to have an umbrella. It's very important coverage for any type of a catastrophe outside of a property claim. So reinsurance real quick, because I know we're a little kind of running on time here, but insurance for insurance companies. Okay, every insurance company is reliant to some extent on reinsurance. The reinsurers are going to pay out a lot with Hurricane Ian. They've paid out a lot traditionally from other, named storm events and other events that we talk about domestically. And the cost of reinsurance is going to increase considerably. in the marketplace. Now, you as an insurer don't pay that directly. This is paid by the insurance carriers that ultimately underwrite your risk. And the first batch of reinsurance treaties that are renegotiated with insurance carriers and the reinsurers, which is a global marketplace, most of the reinsurers are not domestically based, they're internationally based, will be January 1st. So we'll start to see, sort of the result of that trickling down to insureds probably late first quarter, second quarter, third quarter, and then June 1st is the next date for reinsurance. So between those two dates, it's going to be very telling. The costs and the retentions are going to go up considerably for some insurance companies that are more overly reliant on reinsurance, meaning they're going to have to put out more of their surplus that they have for claims before their reinsurance can even begin to pay out, which that alone may just bankrupt a number of companies that are domestic carriers and in the state, meaning the admitted only companies that are not AM Best rated. So if more of those just evaporate over the next 12 months, we're gonna see a more of a capacity issue crunch in the E&S market. You can see more policies go to Citizens. So it's just a sort of a vicious cycle we're dealing with right now, unfortunately, but that kind of remains to be seen. I've touched on capacity. We're already seeing a lot of that super tightening, in the reinsurance markets from what we're hearing. Before any of this happened, Ian, markets were pretty much unwilling to write certain exposures, like barrier islands were very difficult to get anybody to be even remotely interested in. If it was older, if there was any frame, any wood in the construction whatsoever, we're already seeing carriers come out and say, hey, we're no longer going to do anything joisted masonry any longer. No more frame, anything, you could have masonry block, but if you have the wood frame roof, that's going to be a huge issue with trying to find somebody in the standard market to provide any option for going forward. So I think a lot of that's going to end up in Citizens pretty quick. But everything is going to a layered program. I'd say almost everything. The new buildings, the towers still have some potential for a ground up program. There's a couple carriers left that are still doing that, but they will not under any circumstances do older structures, especially now that are more coastal prone, barrier island prone. So it's going to get more difficult. And a lot of these carriers that now are in these layered positions, some of them are retracting out. And that means we have to, in conjunction with the intermediaries that we use, we have to restructure a lot of these programs. And that's going to come with some potentially coverage changes and rate changes, which is, where we come in and getting aggressive and rolling our sleeves up to try to negotiate the most favorable program that we can within the context of the marketplace that we're dealing with. So that's going to be something that's going to be a big challenge for us. There's no question. We're already going through the challenging aspects of it right now. I have a number of renewals that are going on as we speak. So it's a very challenging time. So a couple of things on catastrophic exposed property. These are kind of the items that really carriers look at that relate directly to what you pay, your rate. This is how they model you. They look at these factors for everybody. These are the basic factors that are taken into consideration, apart from all of the other, the macro and the micro issues that we talked about. But, they look at claims. Do you have open claims? That's a huge issue. If you have an open claim, a lot of carriers are going to immediately decline you. It's just going to, out of the gate, they're going to say, nope, we're not interested until the claim is closed. That's going to negate a whole number of different options. And the less options you have, the less competitive as a result that you get when you're dealing with one or two carriers, as opposed to dealing with 15. You're going to have a better result if you have more interested parties involved in that process. The age of the construction, the age of the building is huge. Some companies are immediately just going to decline because of age. They might say, we won't do anything older than 1975 or 1970, just not in our wheelhouse. We're not going to do it. So that's going to have an impact on the availability of companies to potentially be an option. Roof condition, huge item, obviously, for those of you, most of you are aware of that. And I bolded that because that one is within your control to some extent. Okay, so you can re-roof. I know it comes at a cost. I know you just can't wave a magic wand and re-roof. You have to spend hundreds of thousands of dollars to do that. But if you can go to the insurance marketplace and improve your risk profile as an insured to the greatest extent that you can, having a new roof will put you, closer to the top of the pile to get that capacity that we're talking about that's so scarce at this time, where these companies are trying to get the greatest return for their investment. They're going to be looking at the insureds and the risks and exposures that have these better items in terms of, they're older, however, they have a new roof. Okay, we're going to probably want to deploy capacity here versus the neighboring property that has those same criteria, except their roof's 25 years old. They're going to get a way better result than the other property. Geographic location. Nothing we can do about that. So you're either, you are where you are. We can't move your property. You're on a barrier island, you're on the coast, you're on wherever. Nothing we can do. There's no way we can go around that. Some carriers are going to be interested in that. Others may not be interested in coastal risks anymore, at least for the foreseeable future after what just happened. Construction type, can't really change that unless you tear the building down and rebuild it, whether you frame, whether you joisted masonry, whether you're fire resistive, meaning you get the concrete roof, flat roof versus the wood frame, et cetera. That has a huge impact on modeling as well. And then the fire resistant buildings that are more concrete oriented, no wood, are going to model better than the joisted masonry and the frame. It's just a simple fact of the way that this works for these insurance companies. And then opening protections, I bolded that within your control, meaning exterior openings, windows and doors. Are they fully mitigated with impact rated material, whether it's, impact glass, shutters, et cetera? That's another benefit. The carriers that are looking in this market where things are scarce with capacity and availability and reliability of some of these better carriers. If you have the newer roofs and you have the exterior openings fully mitigated, that's the best you can do in terms of really putting yourself out there to be a preferred risk in this marketplace when you have those other items working against you that are not in your control, unfortunately.
Is there a percentage that you would put to if you have a new roof or your roof is in good condition? So the few things that a condo can do besides relocating themselves or rebuilding themselves, roof and windows or sliders, by replacing that, I guess, what's the return on investment, I guess?
Not going to be as much as you think, unfortunately. But it's
That's
not,
right. So,
it's not going to pay for itself in a year. I can tell you that right now. But ultimately, as time progresses and things do get better, because things are all cyclical, and we can sit here in the depths of the worst part of the market and say, "Oh, woe is us. This is never going to get better. Nobody's going to be able to afford to live in a condo." Everything's cyclical: stock market, real estate market, insurance market. There's going to be a correction at some point, and things are going to get better. And you want to be positioned to be at the top of that pile, to get interest from the marketplace with the best products, the best carriers, the best rates possible within the context of that time in the market. And to do that, you need to have those items more fortified than other folks, because there's going to be people vying for that capacity when it does come back, and they're going to get the benefit. But in terms of putting a number on it, it's hard to say where I can say, okay, expect 30 to 40% increases going forward first, second quarter. You might be on the lower end of that scale versus someone on the higher end of that scale when we look at these building component items being improved versus not improved, if that makes sense.
It does. Yep.
So I threw kind of some numbers out here. I took my magic 8-ball, I shook it really good before I got on here. I looked at it, and I'm basically, before Ian, okay, when I had this presentation done before Ian, we had 25 to I think like 35%. Some of the baseline increases we had been seeing prior to Ian was 25. Some of the carriers changed it to 30. Now, in the context of what we're dealing with, because of the uncertainty right now, the existing moratorium until the end of hurricane season, the forthcoming reinsurance renegotiating that's going to be going on, I would be more comfortable saying 40 to 50%. I know everybody's probably screaming at the computer right now. I just want to be realistic with people. I don't want to sugarcoat anything and tell you that, oh no, expect flat renewals. I mean, that's just not realistic, because the other uncertainty is how many of these companies are going to shift their underwriting guidelines, which might create a ripple effect like we talked about with some of those other events, in terms of now those companies might be knocked out of being ones that would compete for coastal risks. Now that means we have less companies to go to. So, this is just going to be kind of a placeholder for now that I would put out there and put in your minds for budgetary purposes, because it's a very difficult time and there's no way around that. And, again, there's been some horror stories I've been hearing of like 200% increases and things like that. I don't think that's going to happen. But I do think in situations where, there's open claims, very complex renewals, maybe, much larger schedules, huge amounts of insurable value, a lot of frame, older buildings with minimal building components upgraded, they might see higher than that range. I would be prepared for that. But I think this is a good sort of guesstimate, if you will, at this point in time, as much as I don't like it. So, rates continue to harden now. We talked about availability. I mean, the hallmarks of a healthy market is reliability of carriers, availability, and affordability. We don't have any of that right now, really, in the Florida market. It's very limited on that scope. So you're just going to continue to see, the terms probably shift. I just had a renewal come in actually this morning, and they're renewing within that window where there's the moratorium. So we're just dealing only with the incumbent carrier renewal, and they shifted the deductible structure. They said, oh, okay, well now we're doing a per building deductible, and they have 6 buildings. Now we're going to do one deductible per the location. And I'm like, wait a second, that's terrible. So we're now going back and forth with them to try to shift back to so they're already trying to sort of, really duck and weave on us on some of the terms, which I'm not a fan of. So we're working on that. So you're going to see some of that, which really speaks volumes to why you need someone to be advocating and really diving into your renewal process and making sure that they're pushing back and not just giving you the first iteration of the quote that comes in from the carrier, because a lot of those first iterations are terrible. And most of my clients never see it because we go back and forth many times before we ultimately present what we think is the best option. So a lot of that is going to be going on. So AM Best real quick, I'll touch on this briefly. So you want to be with an AM Best rated carrier if you can. Benchmark of financial strength for insurance carriers, nationally recognized statistical rating organization. It's been around since 1899. That's sort of the hallmark of financial strength for insurance companies. A lot of the ones that are going under are not AM Best rated. So when you hear about these insolvencies in Florida, you're like, oh my God, the sky's falling. They're not AM Best rated companies. They're all the domestic only companies. A lot of that is more impacting personal lines, but it will have an impact on condos because now all that exposure that was kind of being held by those domestic companies is now going to end up in the AM Best rated space. And they're already scrambling for capacity, in terms of their reinsurance and things. So I just wanted to know this is where you want to be. And then, the next available thing other than this, if this becomes so cost prohibitive, is going to be Citizens. People are going to be looking at Citizens, taking a hard look at Citizens, unfortunately. So flood insurance update, we talked about this. I'm not going to rip through too much of this just because, in general, I mentioned the risk rating 2.0 and sort of the bullet point. This is another thing that insureds are going to have to be dealing with. Again, it's a comprehensive revision of the National Flood Insurance Program, which is going to impact budgets because most folks are going to be subjected to the 18% rate cap every year until they get to that, actuarially sound rate that some bureaucrat decided on for you, at FEMA that we have no control over. We just have to look at that full risk premium and say, okay, well, we're going to get there maybe in 6 years. And then at least we know that the premium will be capped off by then. You won't have to pay anymore unless they change the program again at some point. But, a lot of the things with FEMA that we're seeing, especially now with coverage issues in terms of, storm surge, it's pretty clear that program needs to be just gutted and redone because it's terrible. I mean, it's just a lot of the post-firm buildings, just the coverage that FEMA is not giving it's pretty shocking. But again, it is what it is. I hate to say that, but it's the federal government, okay? That it's been tested. People with Katrina, Superstorm Sandy, Harvey, people have sued, and they've got nothing more than what it says in the policy. So it's just something that clearly needs to be addressed and reformed. But again, we're talking about Congress, we're talking about the federal government. We have to somehow hope that happens at some point in the future, but just something to be aware of budgetarily, you're going to have to be ready for as well on the flood. And then again, some of the rating characteristics they're looking at now, flood zones are immaterial now for rating purposes. They're only important for floodplain management purposes, meaning if the bank requires that there's flood insurance, oh, you're in a flood zone, so you have to have flood insurance. But they're looking now geographic location, your distance to a flooding source, the cost to rebuild, and other property characteristics to determine what they view as your actuarially sound rate. And keep in mind, they want to increase it on everybody because it's a subsidized program. It's like $26 billion underwater, no pun intended on that, but it's just the way it is. And it's because of those big events, Superstorm Sandy, Harvey, Katrina really contributed to, the issues with FEMA because they just continually make payouts on these people and then they just rebuild it all and then it gets flooded again. And then you become a repetitive loss property at that point. Then FEMA takes your policy and they remove the servicing carrier when that happens. I have a few clients that now FEMA is directly administering their flood policy. So it's a very backwards program in that respect that the pre-firm risks, they get coverage for everything when the flood happens, yet people that were post-flood insurance rate now get limited coverage. It should be the opposite in my view. But again, federal government, what do they ever do that makes sense? I'm not getting political. I'm just saying that.
True.
I mean, I don't want to get sideways on this. So yeah, private flood, we've talked a little bit about this with a number of clients in the past. It's not going to be competitive at all with FEMA. Again, how do you compete with the federally subsidized program? Hypothetically, would it be great to have a private alternative to FEMA where you can get more coverage enhancements and provide better coverage? But yeah, the answer is of course, but nobody's going to do that at anywhere near the rate that FEMA charges. It's just going to be so cost prohibitive that nobody would buy it. And we already had that issue before, Ian. We tried to get private flood options for a number of folks that were on the coast, and they were like massively, hundreds of percent more than what FEMA was charging for insurance. So it made no sense. The only way that private flood makes any sense is in an excess flood position where you have the primary FEMA limit, that you have excess over and above that to bridge the gap between what FEMA provides and what your total insurable rebuild value is. But again, that's kind of a risk tolerance policy. It depends on the property. And then legislative wise, 2D, and again, I know I'm like really close on time here. Real quick, so 2D, which was kind of campaigning with 40 during the special session, it did kind of tweak the multiplier methodology that I talked about for attorney compensation when insureds sue the insurance carrier and the insurance companies have to pay the fees of the insured, whether they settle or there's a judgment, through a trial or, a court or what have you. They've changed it now to sufficient and reasonable fees, which is good. That's a good thing. But the problem is that this mechanism still exists. It's like a guaranteed form of payment for the attorney fees, which is not something that is a good thing, because I think it still creates an incentive for folks to want to, take the fraudulent or the unscrupulous route for that cottage industry of those players that has developed in Florida. That's become a multi-billion-dollar industry. So I'm hoping that the new special session coming up in the next month or so will really kind of just get rid of this completely and just say, look, we're not going to do this. No other state in the country does this. Why the heck are we doing it? We've got enough problems in Florida post Ian. So I really hope that they do that. So time will tell. We'll see what happens in the new session. Some other things with 2D, there were some limitations on contractor solicitation of insurance, which is good, where, public adjusters and roofers can't come to you and tell you they're going to pay your deductible. They're going to, tell you that they have to now tell you that, insurance fraud is like a felony, things like that. So there's some good things about that. However, I've still seen roofers and public adjusters casing neighborhoods. I've been called twice by a roofing company in my neighborhood lying about, hey, your neighbor's getting a new roof. It's unbelievable what's going on still, regardless of that. One thing too, which was interesting in 2D, is that there's a provision about roofs, because obviously that's a big thing where folks are saying, oh, we're being canceled because our roof's over 15 years old. Well, now the insurers can't do that if your roof's over 15 years old, as long as you can provide a report that shows that your roof has at least 5 years of useful life left, like an inspection report. I'm not as thrilled about that, because I think carriers are still going to find a way around it. They'll just say, oh, well, you don't fit our underwriting guidelines. They're not going to say roof. So they can kind of get around it from that perspective. Another big piece that'll help the insurance industry is that prior building code in Florida was that if, over 25% or more of your roof was damaged, you have to replace the whole roof, which is crazy. And that is obviously a huge expense for an insurance carrier. But now, if it's 07 or newer Florida building code materials and you have 25% or more damage, you can just replace the damaged portion, which will save the insurance companies a lot in terms of these roof claims that will happen. So that was a good reform with 2D, but much more work needs to be done. And I hope we'll see some of that in the new session that's going to be coming up. And it sounded like DeSantis was saying specifically on insurance only. So that's great. So I hope it's just insurance related. And I hope these legislators step up, because a lot of them are attorneys. And I hope they realize that this is impacting, everybody in the state of Florida, obviously their constituents, but everybody themselves. And I hope they can look past their buddies and their lobbyist friends that are helping support their campaigns and things, because that's what this boils down to. It's a special interest driven situation. And I really hope that they can look past it and put politics aside, and time will tell. We'll see what happens with the new session. Just stay tuned. This is a chart showing some of the domestic property insurers I talked about, that they're admitted only, they're not rated. And you can see the past 2 years, their net income, how much it's fallen, and then their net underwriting losses. So you can tell from a business model standpoint, so many of those companies are going to be going under, and so many have already gone under. Like I said, in September, the sixth one went out of business. And I can tell you right now, in the next 12 months, we're going to have more, because that's what their books look like. And it's terrible. And it's an experiment that failed in the state of Florida, and it's just unfortunate. But we're going to see more and more of that as time goes on. And then this was just a chart showing some of the losses paid to, the Florida domiciled, specialist type property insurers that work in residential property in Florida. And you can see the reinsurance that's paid out, because they're more heavily reliant on reinsurance than some of the big A-rated global players. But again, the A-rated companies still have a massive cost of reinsurance, but the littler companies that are Florida only domiciled, admitted, non-rated, they're way overly reliant on it. So when the reinsurers come up and say, guess what? We're jacking up your retentions this year and your cost of reinsurance is going to double, it's going to put those companies out of business. So we're going to see a big ripple effect from that as well. That just remains to be seen in the near future for next year. And I think I went 2 minutes over. I apologize.
No, that's okay.
That's okay. Lots of good information. There was one question I wanted to go. The following Senate Bill 4D, can an argument be made for self-insurance?
So I've been asked about self-insurance probably 10 times, and I think it's a great question. But the problem with self-insurance, everybody self-insures to some extent, meaning you have a deductible, you have a 5% deductible, you have landscaping that's probably not covered. Things from that perspective, that there's some level of self-insurance with every condo association in terms of things that are not covered. So the first thing to find out that's important is figuring out what you are technically already self-insuring and what that cost will be, and how do you set aside that money for those costs after a major catastrophe. But aside from that, the global question of, well, can we just not have insurance policies and just self-insure? You can. You have to follow the self-insurance, the commercial self-insurance statute in Florida. It's a very overly complicated legal process. I've read through the statute. I don't understand it, to be honest with you. I would ask an attorney, but the short of it is you have to basically create an insurance company. You have to fund it, and you have to get it approved by the Office of Insurance Regulation and the state of Florida. And so you're basically almost creating like some type of a self-insured captive. But then the other big question is, will banks accept it? I have no idea. Nobody knows, because nobody's ever done it in Florida that I'm aware of. We work with like 800 condominium associations. I've never heard of it being done before. And the other issue is that what company is going to be remotely interested in saying, yeah, let me aggregate, give me as many coastal condos as you can in Florida. I'd be happy to be the backstop for that. Nobody's going to want to do that. But there is a mechanism in the statute for self-insurance, and it says an association or a group of associations can initiate that. But to my knowledge, it's never been done, and it would require a pretty substantial upfront capital as well, and the know-how to do it. And again, I don't know. It's an unknown.
Yeah, and I would go back to your point on, are banks going to be okay with that, right?
Yeah, because the retention would be so high that, like any typical captive or self-insurance, would be a huge front-end retention. And typically banks will push back anytime the deductible goes above 5%. I have a few clients that have gone above a 5% deductible, but they're mostly in high-end buildings where everybody owns the unit. There's no encumbrance on terms of a mortgage or anything like that. So they can get away with doing a 7.5 or 10% deductible. But some lenders will say, oh, absolutely not, if somebody tries to sell or, refi or what have you. So it can become an issue.
Yeah. Well, I think what we can look at, as you discussed everything in this webinar, is there's a lot of factors that go into play with your insurance policy and that change the market. So, a couple of questions that came in were, when could we expect things to level off in just South Florida? And as you see from that one specific chart, it's not just what happens in South Florida that affects the market, it's what happens across the United States. So, and these slides, by the way, everybody listening, Sean and I will send these out to everyone who attended and or who registered and couldn't attend, along with a link to this presentation with Joe's information. So thank you, Joe. Tons of good information. Shauna, did we have any other questions that came in?
No, Joe, you obviously covered a lot of information, because we actually have no questions, which I think might be like a record. I'm not sure we've ever done that before. But if anybody thinks of any questions afterwards, like
maybe
Laura
just
said,
signed off and discussed after I talked about the rate increases.
Yeah. If anybody thinks of anything else, so please don't hesitate in reaching out. Laura and I will send emails out, like she said, with the content, the link to this recording, as well as all the contact information for ourselves and for Joe. So you know how to reach us if you guys think of anything more. But thank you. And thank you, Joe, for your time today. That was very informative. We appreciate your time and expertise always. And we appreciate everybody joining us today.
Thanks for having me. Really appreciate it.
Thanks, Joe. Everybody have a good week.
Take
Thanks.
care, everyone.
Thanks.
Bye.
Bye-bye.